Good afternoon from Los Angeles. It's Alyssa Corum and Ed Carson here with a look at the stock market today. It's Wednesday, March 6th, and on today's show, we're going to be talking about the broad action that we're seeing, small caps leading the losses today, also taking a look at potentially an add-on opportunity for a software company and what we're seeing in one international market. So a lot to discuss, but first, let's take a look at the major indexes. So as mentioned, small caps leading on the downside. Russell 2000 down about 1.8% for the day. We have the NASDAQ finishing down 0.9%. The S&P and Dow also logging notable losses today as well.
Yeah, I mean, the major averages, the big cap indexes, are still holding above their 200-day moving averages. The NASDAQ is getting a little closer. So obviously, I mean, there is pressure there. But the Russell 2000, that really never had, that sort of struggled to get above the 200-day to begin with. This is the Russell 2000 ETF. And you can see how it got to the 200-day line but never really got above it. Now it's falling, a little bit harder. So, you might look at the major indexes and say, hey, it doesn't look that bad. And I mean, it's not that bad. We've run up a lot. If you had this ETF, you'd still be pretty happy if you bought it, around the follow-through day in January. But, but nonetheless, it's a pullback. This is definitely a time to be thinking again. Maybe you should take some profits. Definitely shouldn't be thinking too hard about getting into stocks so much.
Right. But it looks like small caps got hit harder during the sell-off and haven't rebounded as strongly, with resistance there at the 200-day line for this proxy for the small cap index.
Yeah, absolutely. And it's just something to be watching for as we go forward.
Definitely. Well, we'll keep an eye on those key support levels across the indexes. But we want to turn our attention to Workday. Those shares continuing to rebound, up fractionally today after two pretty big down sessions as software stocks pulled back. Moving on earnings here was why Workday began to pull back, but maybe the glass half full situation here is there's a potential buying opportunity.
There is technically, I would say, like it pulled back to the 50-day line, which the first and second pullback, you
after a breakout.
After a breakout, you can add some shares. I wouldn't necessarily recommend that, with in this kind of situation with the market being sort of pulling back. But I think one of the arguments is that one reason why you buy top stocks early in a rally is because, well, those might be the big leaders, but in this case, it means there's more of a cushion. I mean, a lot of the stocks, Workday came out around the same time as Palo Alto, Splunk, Autodesk, and those are all good companies, but they all reversed lower. Workday did as well after earnings. I mean, Palo Alto broke out, but then it reversed lower. But those other stocks, which broke out later, they're all below the buy point, some of them really damaged. And so Workday, at least, it came back down. Maybe you could take profits, or maybe if you're holding on, you're not sitting on a loss. And so it's just one more reason why you want to be buying early in a rally.
Exactly. So with the new market uptrend that we're seeing, for those investors who did keep their eyes peeled for those breakouts that we saw early on, as you mentioned, potentially more of a cushion here than stocks in the same group, good companies, good fundamentals, but breaking out later and then getting hit on earnings. Yeah,
because there's always going to be a pullback. I mean, we got up 10 weeks on the NASDAQ, and we haven't had the down week yet. We always seem to rally on Friday. But, those things eventually happen. And so, obviously it's tough to be investing when you have a new breakout right when the market pulls back, because top stocks follow the market. They may say, And this is a clear example of that.
Yes, definitely something to keep in mind. And we've seen a lot of big moves out of China. Huya, for example, YY moved big on earnings too, but China stocks have been more volatile. So one way to play that space, if you're interested in the international market, a lot of the internet companies coming out of China that have been doing well, some recent IPOs, even Tencent Music, just to name one. So how can investors get into this space, maybe with a little less risk?
Well, ETFs are one way to play it. So it's like that company-specific risk, because there were some big losers today, including that electric car maker NIO. One thing is, like, there's a ETF. It's a thrice levered ETF Ying, and this is actually it tracks the FTSE China 50, which is mainland stocks. So these are stocks that don't trade here, but it's risen well. Because the Shanghai Composites had a nice rebound. Another one is KWEB, and that's the Crane Shares China ETF. That one, attracts like Alibaba, Tencent, so more names you're familiar with. There may be a few that don't trade here, but it's just a way that, you don't have that 20% move one way or the other. It's just a little crazy because in a lot of these things, there've been some really wild moves. They're still, when you play a sector play, this has pretty big moves too. It wasn't like you can sit and forget these kind of ETFs.
Yeah, and something that Chris and I talked about when we saw this new market uptrend is how we added, speaking of triple levered, a triple levered S&P 500 ETF to leaderboard. So essentially how we look at individual stocks, breaking out of bases, how you would treat ETFs, perhaps not the same way.
Yeah, you can sometimes play ETFs like a stock, then you have to sell it like a stock too if you're going to do that. But that's early in the rally, that U-Pro, and you can say the same thing with these ETFs in China because there's a few bases that have happened, but a little bit sloppy, a little messy. There haven't been that many breakouts. I mean, Alibaba and some of those are still building the right side of bases, so there aren't a lot of individual names that you really could buy. So that is definitely one way to play it.
Yeah, definitely. Thank you, Ed, and thank you all for watching. Make sure you're heading to investors.com for all the latest stock news and analysis, and that you're checking our content across social media, whether it's on Facebook, Twitter, YouTube, or Instagram. Follow and subscribe for all the latest. Thanks for joining us today, and we'll see you right back here tomorrow.